So the Federal Reserve has delivered a 25 basis point interest rate cut, and they're signalling that they're thinking that they'll probably cut rates twice more this year, with a further interest rate cut next year. Now, you could be forgiven for questioning what are the motivations behind this, because on the face of it, the growth story is pretty good. The economy grew more than 3% in the second quarter. Unemployment is low, inflation is above target, and equity markets are at all-time highs. Well, I think if you dig below the surfaces, things are starting to shift, and the Fed senses that action needs to be taken now. Now, we've got to remember that the Federal Reserve is a little bit different to most other central banks. It targets price stability, but also it looks to maximize employment in the United States. Now, with regards to inflation, it is above target, and tariffs could pose an additional threat to the upside. But at the same time, the impact so far has been more muted than feared. And of course, falling energy costs, slowing housing rents, and also weaker wage growth should also help to mitigate the impact from tariffs. Instead, the labour market is now more of a concern following recent weak numbers and substantial downward revisions. And this is why Chair Powell characterised the latest move as a risk management cut. Monetary policy is still in restrictive territory, and therefore it maybe makes sense to move policy a little bit closer to a neutral setting. We at ING are looking for 2 more interest rate cuts this year and 2 further rate cuts in 2026. And we believe that lower borrowing costs, a weaker dollar, and clarity on the global trading environment will start to stabilise business confidence and lead to stronger growth as we move through 2026. Remember, you can find all of our research at our website.